Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. U.S. Secretary of State Antony Blinken warns Israel it risks fueling a Hamas insurgency in post-war Gaza. Bloomberg has learned that U.S. President Biden is set to quadruple some tariffs on Chinese goods this week. EV duties will jump to more than 100%. And Asian stocks clawing back early losses as sources say China will start selling $138 billion in ultra-long bonds on Friday. Well, it's just gone 8 a.m. across the Emirates. It is 7 a.m. here in Qatar. I'm Jumana Bersachi in Doha. Now, you may be wondering why I am in Doha. Well, let me tell you why. We're gearing up for the Qatar Economic Forum 2024, which begins right here in Doha tomorrow. The theme of this year's three-day event is a world remade, navigating the year of uncertainty. We'll be exploring the issues driving global boardroom conversations and spotlight the Gulf's rising importance. That's as key states strategically deploy wealth to enhance their global influence, diversify economies, and gain international prominence. And we will be speaking to global heavyweights, including the Qatari, Polish, and Malaysian prime ministers, the Saudi finance minister, and the governor of the Turkish central bank. And that is just the lineup for tomorrow. Plenty more to come throughout the course of this week. All right, as ever, let's check in on how these markets are faring. S&P, a bit of an interesting close. We did end up around 0.2% higher yesterday, on Friday. But this after a stronger start, that weaker than expected University of Michigan sentiment print sort of turned things around, turned risk sentiment to the soft side. So that is one of the reasons why the S&P did started to lose some of its ground throughout the session on Friday. Treasuries still sitting at around 4.5%, climbing around 5 basis points throughout the course of the session. Also keeping a close eye on oil as we've been tracking the last couple of weeks into that OPEC Plus meeting. But Friday, oil lost some ground, and you can see that today the futures are down about 0.25% as well. Friday falling more than 1% on demand outlook concerns. And then Bitcoin, we don't usually talk about Bitcoin, but it's been a bit of a rough ride. Now settling in around 61,000, but fell as much as 4% on Friday, has been down for 5 of the 7 of the last sessions, way down by a combination of factors, including these higher yields, 4.5% on 10-year treasuries, and of course concerns about consumer sentiment, as I flagged that University of Michigan sentiment. Our terminal chart today, I think this is interesting because the big data point for U.S. markets this week is the U.S. CPI print coming up on Wednesday. But look at this. Take a look at how super core has been faring. So this is the inflation number if you strip out services, if you keep services but exclude energy and housing. What you are seeing is that blue line has actually started to tick upwards. That is not going in the right direction. And of course, it's something that the Fed are keeping a close eye on. The hope is that these numbers will continue to turn down, but the fact that supercore has been accelerating, something to watch as we head into this pivotal week. All right, let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio, and Avril, I believe there's some news out of China that is driving sentiment this morning. Give us the latest.
Yeah, we are seeing an uptick in sentiment on a day where it's a pretty mixed bag across the region as the focus shifts to those U.S. CPI numbers later in the week. We did get data out of China causing some concerns on the credit front, but to your point, I think in the past hour or so, the focus has been on China saying it'll issue ultra-long government bonds, and this confirms an earlier Bloomberg report. I think the idea here is to raise funds to support the Chinese economy. We're seeing the CSI 300 and the Hang Seng pulling off the session lows. Let's flip the board and take a look at what else we're seeing in China. Bonds ticking up slightly, but the yuan has really been in focus as our MLive colleagues have flagged. It's likely to remain under pressure in the near term, given how this data pointing to traders perhaps hoping for more policy easing. We're also seeing the yuan really in focus in the U.S.-China tensions amid all this talk about tariffs, Jumana.
Yeah, that is going to be a big focus. It's not just tariffs, but also, as you say, the China bond sale has actually been a big turnaround for markets this morning. So you've got the two together. You've got the bad news from a geopolitical standpoint, but the good news from a financing standpoint. Avril in Singapore with the latest. Well, also later today, we are going to bring you an exclusive interview with the French president, that is Emmanuel Macron, of course, about the situation in the Middle East, geopolitics, and international investment. So do not miss that conversation. It's coming up. That is happening at 9 p.m. Dubai time, 6 p.m. in London. But first, hear why UBP says Swiss equity valuations are at a historical discount compared to the U.S. counterparts. We're going to be talking market strategy up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Doha. U.S. Secretary of State Antony Blinken says Israel risks fueling a Hamas insurgency in post-war Gaza. It's the latest warning in a steady escalation of U.S. concern about Israel's conduct of its Gaza offensive.
Israel's on the trajectory potentially to inherit an insurgency with many armed Hamas left, or if it leaves, a vacuum filled by chaos, filled by anarchy, and probably refilled by Hamas.
Well, joining us now is Sam Daher, our Middle East economics and government reporter in Dubai. Sam, really interesting commentary from the Secretary of State Blinken over the weekend, and also U.S.'s strongest criticism yet of Israel since October 7. How are you reading those comments?
Yes, hi, good morning, Jumana. I mean, just very quickly on what Blinken said about the risk of Israel inheriting an insurgency. I mean, almost like to his point immediately, I mean, we had overnight clashes in northern Gaza. I mean, this is an area that Israel declared that it was clear of Hamas militants months ago. I mean, that's where it started its invasion of Gaza more than 7 months ago. And just overnight, we had reports by the Associated Press of clashes in the Jabalia refugee camp and also the neighborhood of Zaytun, which is near Gaza City. And I mean, that really is almost like confirmation of what Blinken warned about.
Yes, and indeed, you know, in those comments, he said Israel risks holding the bag on an enduring insurgency. So a very cautionary tone there. But let me just ask you about what is actually happening in Rafah. Again, reports of the weekend that another 100,000 people left Rafah by foot. That brings the total tally to 300,000. The expectation on the ground is that this larger ground assault may still actually take place.
Yes, Jumana. I mean, we have a very compelling story from our colleague Faris Akram. I mean, he is from Gaza, but he's reporting for us from outside Gaza, obviously talking to people there. And we have like this really compelling account of how people are moving en masse from Rafah to this area called Al-Mawasi, which is on the coast near the town of Khan Yunis. And you know, Faris's report, I mean, we hear about people paying as much as $1,000 for a tent. I mean, they're moving to an area where there are already almost 500,000 people living in tents in horrendous conditions. I mean, no food, no water, no sanitation, you know, basically living amid destruction, because these areas where they're moving to have been targeted by Israel, you know, in the past.
$1,000 for a tent. Wow. Sam, but of course the background to all of this is the ongoing discussions about a potential truce deal. Again, we got some commentary from Turkish President Erdogan over the weekend saying that US and Europe aren't doing enough to pressure Israel to agree to a ceasefire. What is the latest there, and what are we hearing as well from other Arab states?
Absolutely. Good question, Jumana. I mean, we were all following very closely the talks in Cairo. On the U.S. side, they were being led by the CIA director, William Burns, and we have also a good story on the terminal about his role in all of this. In fact, a lot of officials that I've spoken to here in our region were very optimistic, you know, that Burns was involved, someone like him with a lot of experience and kind of operating quietly that we would see results, but unfortunately, he left, and then we had Israel, a week ago commence its invasion of Rafah. So, obviously, all eyes are going to be again on whether we're going to be able to renew those talks in Cairo or elsewhere. Those talks, in addition to the U.S., we have the Egyptians playing a key role, and there were obviously the Egyptians talking to Hamas directly, and then we had Qatar playing a very important role. Egypt, which has been playing a very important role in these talks, is now saying, after Israel's incursion into Rafah, that it may join South Africa in its case, at the International Court of Justice, accusing Israel of genocide, and also there are Egyptian officials warning that Egypt's peace treaty with Israel is actually in peril.
Oof, strong words there. Yeah. Of course, one of the first Arab countries to sign a peace treaty with Israel back in the 70s. Sam, thank you so much for your coverage this morning. That was Sam Dared, our Middle East economics and government reporter in Dubai. Now, turning to some markets news, Chicago Fed President Austin Goolsbee says he doesn't think inflation is stuck above the central bank's target.
There isn't, at this time, much evidence, in my view, that inflation is stalling out at 3%. If you take a step back, what's happened is inflation went way up in the United States and in everywhere else in the world.
Well, let's bring in Eleanor Taylor Jolidon, the co-head of Swiss and Global Equity at Union Bancaire Privee. Good morning to you. Wonderful to have you with us on the show. The big event for markets this week is going to be that U.S. CPI number. And early on in the show, we put up a chart about how Supercore has been faring. That's services adjusted for energy and food prices. And what's interesting there is that number has actually been trending upwards. My feeling is perhaps the market is getting a bit complacent about the trajectory of these numbers, and we may be in for a hawkish surprise this Wednesday. How are you feeling about things?
Well, clearly, inflation is going to be more sticky than perhaps some market participants were expecting. And it's not a huge surprise to me to see that Supercore number, in terms of the fact that one of the upward pressures on inflation has obviously been wages, and that obviously does get itself expressed perhaps to a greater extent in the services space than in other areas. So we can't have everything. We are fortunate that, in fact, growth numbers in the United States are looking better than perhaps some people were fearing at the beginning of this year, and certainly at the end of last year. But that does mean that we continue to have some of the stresses on the economy, which were also present at that stage, notably in the labour market, which continues to be very resilient, which is good news, again, for workers in the United States. And it does mean that one does have to be somewhat cautious then in terms of what one is hoping for, if that is the hope, in terms of rates coming down. I would argue that we're probably in a slightly better environment, at least for equity markets, because we have got that growth, but that does come at something of a price as well.
I just want to ask you about another bit of data we got on Friday, that University of Michigan sentiment indicator dropping to a 6-month low. That a reflection of how U.S. consumers are feeling about the economy. So you put the two together, you have stickiness in inflation and you have sentiment indicators turning south. That is a recipe for stagflation, isn't it?
Well, clearly the Fed does not see stagflation, and I rather join them on that. We do have a tendency of exaggerating perhaps the negatives around us. And it is true that there has perhaps been a slower drop down to the consumer in terms of some of the improved conditions that have been seen over recent months, and services is an important part of people's lives, and people are aware of those numbers remaining resolutely quite high. But let's not forget that as wages continue to perform strongly, as the employment market also continues to perform strongly, that means that there is less fear of losing work. There is less of a cyclical up and down swings ahead of us. And bit by bit, that probably will filter into the consumer's pocket. But it's not a perfect scenario. No, you're absolutely correct.
Let me take it to markets because the consensus estimate for growth for US stocks is still sitting at around 9% this year. Do you feel that that number is too high in light of everything that we just spoke about now?
Absolutely not. I mean, again, the problem with having growth is that that may lead to some upward pressures on inflation. We were in a very unusual situation up until and during the pandemic that we had very low inflation, but I wouldn't say that that was normal. We need to go back to before the great financial crisis for a normalized situation when it comes to the effect of growth on inflation. So that 9% does seem to be underlined on what is a much more important number as far as I'm concerned, which is the actual fundamental earnings growth of companies. And we've actually had a good first quarter report. And what has been also quite encouraging is that we are seeing a broadening of that earnings growth as opposed to what we saw in 2023. Remember that in 2023, the earnings growth in the US came from a very narrow set of stocks. This time around, we're seeing much more involvement of other areas of the economy. And that also, I would argue, will feed through to the consumer as well, as they see that the activities in which they are involved are also performing better than they were in 2023.
Yeah, that broadening of market leadership is going to be a big question for investors this year. Eleanor, we're going to leave it there. Thank you so much for joining us on the show. Eleanor Taylor Jolidon, the co-head of Swiss and Global Equity at Union Bancaire Privee. Now, coming up, President Biden is set to hike tariffs on a range of Chinese goods this week, with EVs in the crosshairs. All the details coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersetchi in Doha this morning. Now, the Biden administration is set to significantly hike tariffs on some Chinese goods this week. Our sources say that it includes nearly quadrupling duties on Chinese-made electric vehicles. Now, our China economy editor, James Mager, is here with the details. James, on Friday, we previewed that a decision like this would be coming this week, and it seems like some of the details have started to emerge. What can you tell us?
As you said in your introduction, the Biden administration looks to be going to come out with an announcement tomorrow, I guess so late Tuesday, China time, on increasing tariffs on Chinese EVs and on other industrial goods. It's steel and aluminium is definitely going to see a tariff increase. It's unclear what other goods specifically are going to be tariffed at this point, but the aim of this is, the stated aim of this is to stop a flood of Chinese EVs from coming into the US market. Then there's also trying to, obviously the Biden administration is trying to develop an EV sector and a solar panel manufacturing sector, and they're trying to protect US companies from the much cheaper goods of those that China can make and sell.
I was reading a report from Bloomberg over the weekend suggesting that a lot of this move actually is symbolic, namely because in reality, not that many Chinese electric vehicles are imported into the US. So how do we read this decision from the Biden administration, given that on the ground, economically, it probably won't make that much of a difference?
I think that's definitely the case on EVs. I think one of my colleagues said that only 1% of US EV imports are actually from China. So basically they're tariffing a good that the US doesn't buy from China. And even without these tariffs, the Commerce Department now has an investigation into what they're calling connected vehicles, which is probably aiming to stop cars, electric vehicles from China from coming into the US market as well. So the tariffs, I think, on EVs specifically aren't really meaningful in an economic sense. What is more interesting, I think, is that you're also looking at tariffs on batteries, and the U.S. has been a big buyer of Chinese car batteries for electric vehicles. More than $1 billion of those purchases each month for the last, I think, for more than a year now. So demand for those seems to be slowing in the US as EVs haven't taken off as fast as possible. But if the Biden administration does bring in tariffs on Chinese battery exports, I think that's actually going to be quite significant. The problem is that there's no other country in the world, there's no other companies in any other country in the world that can make the batteries at the cost that China can make the batteries at this point. So the Biden administration, if they do that, is just going to drive up costs for EVs, which are already way more expensive than petrol-driven cars. So I think they're trying to, obviously they're trying to have a balancing activity between stopping imports of things that the US also wants to build, but also they're not driving up costs too much just before an election.
Yeah, it's a fine balance. James, thank you for bringing us all the details there. China economy editor James Mager joining us on the show. Now, for a look at some of the other stories that we're following this morning, Russian President Vladimir Putin has replaced his long-serving defense minister in a surprise move. Sergei Shoigu had been in the post since 2012. Now, the reshuffle is the first major shakeup of the Kremlin's military leadership since the Ukraine invasion and comes as Russian forces seek to capitalize on a battlefield advantage in the war. Ukraine's leader Volodymyr Zelensky has called on his people not to panic as Russia's advance in the Kharkiv region threatens a local city. He called the situation on the outskirts of Vovchansk extremely difficult after orders were given for a mass evacuation. Earlier, Russia reported multiple deaths after the partial collapse of a residential building it said was struck by a missile. And later today, we will bring you an exclusive interview with French President Emmanuel Macron about the situation in the Middle East, geopolitics, and international investment. That is at 9 p.m. Dubai time, 6 p.m. in London. And a quick look at the market boards before we head out to the break. And as you can see, equity futures not doing much, trading sideways. Nasdaq seen opening up slightly up in the green. We'll be right back in just a few moments. This is Horizon's Middle East and Africa, our top stories this morning. U.S. Secretary of State Antony Blinken warns Israel it risks fueling a Hamas insurgency in post-war Gaza. Bloomberg has learned U.S. President Biden is set to quadruple some tariffs on Chinese goods this week. EV duties will jump to more than 100%. And Asian stocks clawing back early losses as sources say China will start selling $138 billion in ultra-long bonds on Friday. Well, it's just gone 8:30 a.m. across the Emirates. It is 7:30 a.m. here in Qatar. I am Jumana Versace in Doha this morning. Well, why am I in Doha? That is because we are gearing up for the Qatar Economic Forum 2024, which begins right here tomorrow. The theme of this year's three-day event is A World Remade, Navigating the Year of Uncertainty. We'll be exploring the issues driving global boardroom conversations and spotlight the Gulf's rising importance. That's as key states strategically deploy wealth to enhance their global influence, diversify economies, and gain international prominence. We will be speaking to global heavyweights, including the Qatari, Polish, and Malaysian prime ministers, the Saudi finance minister, and the governor of the Turkish central bank. And by the way, that is just the lineup for tomorrow. We have plenty more fascinating discussions and panels coming up throughout the course of this week, so we will bring you those as they happen. Quick check on markets now. We spoke about the S&P, Nasdaq sort of trading sideways, but the close yesterday we saw the Nasdaq and the S&P end about 0.2% firmer. Of course, in the afternoon, once that University of Michigan sentiment indicator came out, we did see risk turn around a little bit. Treasuries about 5 basis points higher in the session. on Friday, closing at around 4.5%. Crude also on our radar, down 0.3%. We have a guest coming up. We're going to talk more about what's been happening in that complex. And then Bitcoin sitting around 61,000. We did drop around 4% on Friday. Its fifth losing day out of 7. As for our terminal chart today, well, the one big focus for markets is going to be that U.S. CPI print. Interesting here to note that the super core number, which is the inflation print adjusted for housing and energy, has actually been on the rise. That is not in the direction that Fed or central bankers want to see it going. So something to bear in mind as we head into that all-important print coming out on Wednesday. But let's also check in on how markets in Asia are faring. Avril Hong is in our Singapore studio, standing by and taking a look at how on one hand you've got the geopolitics playing, and on the other this potential issuance of Chinese bonds to come as well.
Absolutely. I think that bit of information about how China is going to be issuing these ultra-long sovereign bonds is lifting sentiment a little. The idea here that it will help it to raise funds in order to support the economy. But that being said, you can see how there's really not a lot of appetite for risk. The stock gauge is down. It's not just the US-China tensions and the threat of tariffs. It's also as the focus shifts towards the US CPI print later in the week. We did see some tick up in Chinese 10-year government bonds. Japan's bonds going the other direction after the BOJ today reduced the purchase of some of these bonds. And some say that this could be a way for it to test the water before it starts scaling back its massive purchases. Let's flip the board. I want to take you to the data that we've been focusing on out of China as well. It wasn't just weak inflation numbers. It was also on the credit front, aggregate financing, which is a broad measure of credit. It's slumped for the first time since 2017. This was when the data first started being tracked. And the concern here, even though some have said that it's due to seasonal factors, the concern is really because the PBOC has been pumping in ample liquidity, but it looks like households, businesses, they're not biting. So adding to the concerns related to the Chinese economy, Jumana.
Yeah. And of which there are many at this point. Avril, thank you so much for the update. Let's turn to oil now. The energy complex has been declining as weak Chinese data that Avril was just talking about raises concerns about demand. Brent is falling towards $82 a barrel, but our next guest thinks $90 is going to be the sweet spot for crude. So joining us now is Aldo Spanjer, the Senior Commodities Desk Strategist at BNP Paribas. I've got to say, Aldo, I'm a bit surprised, just taking a step back, at some of the price action that we've seen in oil over the last couple of weeks. I would have thought with the geopolitical premium around the Middle East, concerns about what's happening in Israel, Gaza, that would have had more of an impact on the price of oil. In addition to that, we know that for a while now, since at the end of last year, OPEC Plus had been actively taking barrels off the market. Why isn't oil more supported?
Yeah, thanks, Jumana, and thanks for having me. Yeah, so look, it's been a reasonably wild ride. If you go back through the last couple of months, I think we went to 90 first on effectively people seeing the actual OPEC cuts materializing to a large extent, and seeing a bigger risk premium, I suppose, out of the Middle East being priced in. I think the recent drop-off we've seen, it's a few reasons. It is, I think, a risk premium being priced out. And it's also, if you look at the fundamental side of things, April is the weakest month for refinery runs seasonally. So you will always see low demand in April. And I think we're partly seeing a correction to what I think right now, 83-ish, probably quite close to fair value, given where we are in the year in April.
How is positioning right now? It's often the case that when you see moves like this, the main culprit is just that people got too long. And I wonder whether, given the pullback that we've seen again over the last couple of weeks, that some of that long positioning has started to get trimmed.
Yeah, very much so. So you basically have seen the longs from early April effectively. They've stepped out of the market, and that helped the trend down basically. Now you see much lower long positioning in the market, which means that the levels we are at currently, you're probably going to see them for, I would think, for a while, in that people are probably, and we can talk about that, but people are probably relatively bullish a bit further out in Q3. In Q2, I think people tend to be a little bit more conservative, particularly on seeing refinery margins being very low, worries about Chinese demand. And so I think the long positions coming back, they will come back probably, but not anytime soon. I think May, June might still remain relatively weak.
Interesting. Well, let's talk about the next big event for the market. That is the upcoming OPEC Plus meeting. I've got to be honest, I haven't seen one analyst out there that is expecting a change in production levels. What have you penciled in, and why do you think they are going to stand pat? Why are they not going to change the quota guidance?
No, I mean, the short answer is we're not at the right price. So basically, again, we've seen these expectations shift. So we've been consistent on seeing OPEC stay the course through the entire year, effectively, from Jan onwards. But when in April, when prices hit above 90, you start seeing people making outlooks in that probably in Q3, when the market will be tightest, maybe there's an opportunity to bring some supply back. Right now, we're not close to 90. I think we're going to go there in Q3. But the sweet spot, I think, is around 90, maybe even a little bit higher in terms of the structural price OPEC Plus would probably want to have. That means you need to be quite a bit above it for quite a while before you start bringing supplies back, because it will come off. So I think right now, not many people will see the fundamentals supportive to start bringing supplies back. And we still believe that even in Q3, Q4, OPEC will have to stay the course to keep prices close to their aspired level.
You know, we're here in the Qatar Economic Forum, and I'm going to be speaking to many people on the ground, including the Saudi finance minister. You've actually inspired me to ask a question there. Let me ask you why you think $90 is that magic number. And is it a number that OPEC Plus would like to see, or is it a number that you think the Saudis would like to see because it will help them balance their budget?
Yeah, it's the latter. So look, it's tricky because every OPEC Plus member, of course, has a different price they'd like to see. What we tend to use as a gauge is fiscal break-evens for Saudi, which seems to be consensus around 90. I see some people going to 85. I saw the IMF going to 100 because their exports go down. But 90-ish seems to be a reasonable gauge. And again, to me, that means you need to be well above 90 for at least, not a week, but for probably a month, maybe two, before you really can see significant supplies come back. And right now, as you can see on the screen, the market is not there. We might get there in Q3, but not in Q2.
Fascinating. Well, we'll have to come back to you after that OPEC Plus decision and see how successful OPEC Plus are at putting a floor under the price of oil. Aldo Spanjer, Senior Commodities Desk Strategist at BNP Paribas. Thank you, and thank you for coming in early this morning in London. Also coming up, the global chip showdown is heating up. We're going to discuss the race between major superpowers to control the next generation of semiconductors. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Doha this morning. Let's turn to Softbank Group, which reports fourth quarter results in a couple of hours. The Japanese investment firm has been shifting away from high-profile targets via its Vision Fund and towards strategic bets on AI and chips. Well, for more on what this means for its bottom line, technology reporter Min-Jong Lee joins us now. And Min-Jong, what are we expecting from these fourth quarter results, and to what extent is their return to profit or expected return to profit going to be underpinned by some of these investments in AI? And of course, ARM is the big one.
Yes, for the fourth quarter and also on an annual basis, we are anticipating some sort of a recovery. Any profits won't be that huge, but because the losses had been quite significant in a year earlier, we are going to see a significant narrowing of the losses in the least. And this does help SoftBank kind of get ready for new investments, like you mentioned. And we're seeing Masayoshi Son focus shift increasingly toward AI with a particular focus on chip technologies. And Softbank has been accumulating quite a lot of cash recently, so it'll be very interesting to see any kind of new investments that Softbank has in plan going forward.
It feels to me that there's been a bit of a change of strategy, a lot more investment directed towards AI, towards chips. ARM, as we know, they have more than a 90% stake in ARM, and it's done very well since the IPO. But at the same time, the Vision Fund has been selling down assets. What does that mean for SoftBank Group as a whole?
So we're seeing the Vision Fund has been quite busy in recent months, quietly selling down a lot of stake in its mature U.S.-listed assets. Based on the SEC filings, we see that about $29 billion worth of these assets have been reduced over the past couple of years. And this coincides with Son's shifting focus toward AI and chip technologies. And in recent investment deals like Wave, we're seeing that these investment strategies are made for the SoftBank Group and less for the Vision Fund. So we're seeing a kind of a strategic shift towards SoftBank Group under Masayoshi Son and less of interest in the Vision Fund, the institutional fund model itself. So it'll be a lot of focus is on today's presser as well to see if there are any more clues.
Yeah, and to that point, I wonder to what extent the market is going to be watching to get any further clues on what other investments that the Vision Fund has made, and how likely is it anyway that we're going to get that much transparency?
I think the odds are not that high that we'll see a surprise announcement this time around, but never say never. So a lot of people are bracing for any surprise investment announcements, possibly more from the SoftBank Group side and less likely from the Vision Fund, but we'll see what happens.
Very fair. Technology reporter Min Jung Lee, thank you so much for giving us a little preview on what we can expect out of SoftBank earnings later today. Well, superpowers led by the US and the European Union have funneled nearly $81 billion into producing the next generation of semiconductors. That's escalating a global showdown with China for chip supremacy. Senior analyst at Bloomberg Intelligence, Robert Lee, has more on today's big take. And it is interesting, Robert, to see this sort of tech chip war heat up over the last 12 to 24 months between the US and China, not to forget Europe as well, but mainly US with the launch of the CHIPS Act. How do the two approaches compare? You've got the US with the launch of the CHIPS Act, a big piece of legislation that came through, and then you've had China's approach, which has been more driven by the States and over the course of the last few years now.
Yes, that's right. I think within the States, they've woken up to the fact that they're highly reliant on East Asia and Taiwan in particular for the supply of semiconductors, not just mainstream semiconductors, but more importantly, advanced semiconductors. So their strategy is really to try and reshore things, following sort of 20 years or so of offshoring. So much from mainstream assembly to semiconductor fabrication, you name it. So there's an effort to reshore things back into the States with a focus on leading edge semiconductors and also trying to really boost the long-term prospects of their domestic players, such as the likes of Micron and Intel. Whereas compare and contrast, I mean, China's long-term aim is really technology self-sufficiency. So that's really what's driving their investments on the semiconductor side, and they're putting substantial amounts of long-term investment into that, but they're really playing the long game. The major issue that China faces at the moment is obviously the export bans on advanced lithography equipment from ASML in Europe. So they're focusing more on the mainstream semiconductor market as a result.
Yeah, I mean, but that point is key, right? Because, my understanding, we have to obviously differentiate between all of these different types of semiconductors. You've got, the ones that are mass produced, you've got memory chips, but then those avant-garde, those cutting edge technology chips are much more difficult for China to get the right technology in order to be able to manufacture. So I wonder to what extent, from a strategic standpoint, it's going to be quite challenging for China to overcome those hurdles and be able to catch up with the US.
Yeah, these chips, particularly at the advanced leading edge, are made, they operate at the cutting edge of technology, the cutting edge of physics. They're built at the atomic scale. So you really need these advanced EUV or extreme ultraviolet machines that are only really supplied by ASML out of the Netherlands. So in the absence of those machines, it's a major technological hurdle for China to overcome, which is arguably going to take them many years, if not decades, to overcome. So as a result, I think taking a more pragmatic, sensible approach, they're focused more on the mainstream.
Makes sense. And Robert, if everyone is making more chips, let me just ask you, could we get to a supply glut? Are there going to be too many chips on the market?
I think that's the risk, because clearly we are going into a period of slowing economic growth, with some out there maybe forecasting potential recession over the next few years. So with supply coming on, as you've said, both in China, in Taiwan and in Europe and the US, there's a risk of that happening. Also, the cost of production in the West is likely to be substantially higher than it is in East Asia, and therefore there's a whole question about inflation as well, as to whether these moves could stoke that. So I think there are some longer-term strategic, challenges that and unknowns that could come as a result of this. I'd also say, we shouldn't underestimate the scope for China to retaliate, because clearly China is still a massive market of 1.4 billion consumers, which is highly reliant on US technology and US products. So as they make further progress on self-sufficiency, there is a question mark as to the sustainability of demand for major US tech exporters into China, the likes of Intel, the likes of, really across the board, really. China's a massive market for US companies. So it cuts both ways, I think, is the point I'm trying to make there.
Yeah. A very clear, fascinating report. That was Robert Lee, our senior analyst at Bloomberg Intelligence. Thank you. And you can read more on the big take on the terminal. Also coming up, Africa's largest wireless company, Vodacom, releases full-year results later. We are going to be live in Johannesburg for a preview coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Doha. Africa's largest wireless company, Vodacom, releases full-year results today. Analysts think revenue probably grew more than 1/5, boosted by data traffic. In South Africa, price increases likely offset the impact of high unemployment and electricity shortages, pushing top-line growth close to 5%. So joining us now to discuss what we can expect when these results come out in around 10 minutes' time is Lonnie Prinsloo, Bloomberg's Africa Telecoms reporter in Johannesburg. So what are we expecting? It seems like on one hand, they are managing to push through price increases, but on the other hand, the macroeconomic issues are at play as well.
Hi, Jumana. So yes, we are expecting about a 20% increase in sales, though. This is basically because Africans are increasingly turning towards their smartphones, spending more time on the internet for services such as financial services and entertainment, all of which telecoms companies like Vodacom also provide their users. That is basically bolstering all of these companies' earnings at the moment. What we also expect is for them to still pay out quite a big dividend, 75% of the adjusted headline earnings. They did cut back on the dividend policy last year as they try and preserve more cash for things like Egypt and Ethiopia. That's their newest markets.
Well, Kenya's biggest telecom operator, another African telco, Safaricom, had very strong earnings last week. So compared to its peers, why is Vodacom underperforming?
Jumana, so Vodacom actually does own quite a big chunk of Safaricom, and it is still the biggest. But they do have a few things in play. As we said, the biggest market is South Africa, which is Africa's most developed economy, but it's struggling at the moment with power cuts. So what comes with power cuts is you have to bring on generators, you have to bring on fuel, and that of course comes with additional costs. Also in South Africa, they're trying to get a big fiber deal over the line, which is quite essential for them. But the competition authorities did block this deal initially. So later this month, it will be heard again, and we'll wait and see what happens there. On top of that, as I told you, they are trying to build out network in Egypt and Ethiopia. So in Ethiopia, for instance, you are starting to build out network from scratch when you build there, which is quite expensive. So I think what is happening is that investors are playing a bit of a wait-and-see game to see which of these bets are going to pan out, and if they can make a few clever deals with their fintech business, with their infrastructure businesses. So I think that's what's happening.
All right. Lonnie, thank you so much. That was Lonnie Prinsloo, Bloomberg's Africa Telecoms reporter in Johannesburg. Well, there's not much left for me to say apart from thank you for watching. That was Horizons Middle East and Africa. I'm Jumana Versace in Doha, and I will be in Doha for the rest of this week for the Qatar Economic Forum.